In mid-2025, global sectoral debt reached $340 trillion, with the government share of that debt reaching a record 30%, or approximately 3 to 4 times global GDP. This fiscal trajectory has revitalized the precious metals trade, as investors increasingly view precious metals as a hedge against sovereign debt risk and the long-term debasement of fiat currencies. Newmont, Agnico, Barrick, and Kinross have emerged as primary conduits for institutional capital seeking leveraged exposure. The mining sector offers a mechanism of operating leverage in this environment. Historical data suggests that because mining companies maintain high fixed costs related to labor, equipment, and energy, once the gold price exceeds the break-even threshold, nearly every additional dollar of revenue flows directly to the bottom line. In current market conditions, a 10% rise in the gold price can result in a 50% jump in profit margins for the most efficient producers.
Newmont maintains its position as the leader in global gold production, underpinned by a 2025 production guidance of 5.6 to 5.9 million attributable ounces. Following the integration of Newcrest Mining, Newmont has transitioned into a portfolio optimization phase, focused on divesting non-core assets to sharpen its focus on Tier 1 operations, mines capable of producing over 500,000 ounces of gold annually with a minimum 10-year mine life and bottom quartile costs. In the fiscal year 2025, Newmont executed a divestiture program, generating approximately $3.5 billion in net cash proceeds from the sale of assets such as the Akim contingent payment and the Coffee Project. This liquidity, coupled with a record third-quarter free cash flow of $1.6 billion, enabled Newmont to retire $2 billion in debt through a tender offer, ending the year in a near-zero net debt position with $9.6 billion in total liquidity. Newmont is executing a $6 billion share repurchase program, of which $3.3 billion was utilized by late 2025. This program, combined with a quarterly dividend of 25 cents per share, reflects a strategy aimed at returning over $1.25 billion annually to shareholders while maintaining a healthy balance sheet.
The primary operational catalyst for Newmont in 2026 is the full ramp-up of the Ahafo North project in Ghana, which reached commercial production in late 2025. This asset is expected to contribute approximately 50,000 ounces in its initial months, scaling to an annual output of 275,000 to 325,000 ounces over the next 5 years. Additionally, the Red Chris underground project in Canada represents a significant copper-gold growth vector, with development capital shifted to 2026 to ensure efficient deployment during the study and construction phases. The operational metrics for Newmont in the third quarter of 2025 highlights the following: attributable gold production, 1.42 million ounces; realized gold price, $3,539 per ounce; free cash flow, $1.6 billion; all-in sustaining cost, AISC, $1,670 per ounce for the third quarter; net debt position, near zero.
The bull case for Newmont is predicated on its massive scale and its unique position as the only gold producer in the S&P 500 index. With 134.1 million ounces of gold reserves and 13.5 million tons of copper, Newmont offers exposure to critical metals. The successful completion of its non-core divestiture program has removed the conglomerate discount, allowing the market to value its Tier 1 assets more accurately. Furthermore, the company's ability to generate over $1 billion in free cash flow for 4 consecutive quarters demonstrates a high-margin business model capable of thriving even if gold prices stabilize. The bear case centers on the complexity of its global footprint and the risks inherent in large-scale asset integration. The retirement of CEO Tom Palmer on December 31, 2025, introduces a period of leadership transition that could impact strategic momentum through 2026. Operationally, Newmont's all-in sustaining costs are among the highest in the senior peer group, forecasted at $1,630 per ounce for 2025. This cost profile is sensitive to inflationary spikes in labor and energy, which could compress margins more severely than for lower-cost peers like Agnico Eagle. Additionally, nearly 20% of Newmont's assets face moderate to high physical risks such as cyclones in Western Australia, which could introduce unexpected downtime and capital expenditure requirements.
Agnico Eagle Mines is increasingly viewed by institutional analysts as the highest-quality senior gold producer globally. Its strategic concentration in low-risk, politically stable jurisdictions, Canada, Finland, and Australia, has allowed the company to trade at a consistent jurisdictional premium over its more globally dispersed peers. Approximately 85% of Agnico's gold production and 87% of its reserves are located in Canada, minimizing the threat of resource nationalism and geopolitical upheaval. In the third quarter of 2025, Agnico Eagle reported record-adjusted net income of $1.085 billion and generated free cash flow of $1.19 billion. The company has used this windfall to aggressively deleverage, reducing its long-term debt to a mere $196 million and ending the third quarter with a net cash position of $2.16 billion.
This low debt profile, with a debt-to-capitalization ratio of approximately 1.2%, provides Agnico with significant financial flexibility. The company has consistently raised shareholder returns, repurchasing over 1 million common shares for $150 million in Q3 alone, and maintaining a sustainable quarterly dividend of 40 cents per share. The financial and operational indicators for Agnico Eagle in late 2025 include realized gold price, $3,476 per ounce, adjusted net income, $1.08 billion, net cash position, $2.159 billion, production guidance, between 3.3 and 3.5 million ounces, long-term debt, $196 million. Agnico's growth is driven by the internal development of its vast pipeline rather than large-scale acquisitions. The Odyssey project at the Canadian Malartic Complex remains the company's primary growth catalyst, with record underground development of 4,850 meters achieved in a single quarter. Additionally, the Hope Bay project in Nunavut, with 3.4 million ounces of proven and probable reserves, is expected to be a major contributor to cash flow in the coming years, with a preliminary economic assessment expected in the first half of 2026.
The bull case for Agnico Eagle rests on its peer-leading cost control and operational consistency. The company's AISC for 2025 is forecast between $1,250 and $1,300 per ounce, providing massive margins at current gold prices. Unlike competitors, Agnico maintains a no-hedge policy, ensuring that shareholders receive the full benefit of the gold price rally. The company's focus on high-grade deposits in stable regions has led to a return on equity that significantly outperforms the sector average, making it a core holding for risk-averse institutional investors. The bear case is largely a factor of valuation and near-term production limits. At a forward PE multiple of approximately 17.8 to 21x, Agnico is the most expensive stock in its peer group, which may limit further upside if the gold market experiences a consolidation phase. Furthermore, while its balance sheet is a fortress, Agnico's production profile is expected to remain relatively flat between 3.3 and 3.5 million ounces until major projects like Odyssey and Hope Bay fully ramp up after 2028. Any delays in these long lead time projects could dampen investor enthusiasm. Finally, high gold prices have increased Agnico's royalty costs, which are expected to push its 2025 AISC toward the higher end of the guidance range.
Barrick Gold has adopted a strategic direction that diverges from the pure gold focus of Agnico Eagle. Under the leadership of Mark Hill, interim CEO in 2025, Barrick has transitioned into a multi-asset producer with a significant and growing interest in copper. The company views its future as a global leader in both precious and base metals. Barrick's operational foundation is its 61.5% stake in Nevada Gold Mines, a joint venture with Newmont that represents the single largest gold-producing complex in the world. Despite a 16.7% decline in gold production in the first half of 2025, attributed to maintenance and geopolitical challenges in Mali, Barrick generated a record $2.4 billion in operating cash flow and $1.5 billion in free cash flow in the third quarter of 2025.
The company's growth profile is heavily weighted toward its Tier 1 copper projects. The Lumwana expansion in Zambia is expected to increase annual copper production to 240,000 tons, while the Reko Diq project in Pakistan remains on track for production by late 2028. Collectively, these projects are expected to drive a 30% growth in gold equivalent production by 2029. Barrick maintains a balance sheet with a debt-to-equity ratio of 18.3% and a net cash position of $73 million as of mid-2025. The board approved a 25% increase in the base quarterly dividend to 12.5 cents per share and expanded its share buyback program to $1.5 billion.
Key performance indicators for Barrick in 2025 include gold production attributable 829,000 ounces in Q3, operating cash flow $2.4 billion, gold AISC guidance $1,460 to $1,560 per ounce, copper production guidance 200,000 to 230,000 tons, share buyback authorization up to $1.5 billion.
The bull case for Barrick is built on its deep value and copper optionality. Currently trading at 13.2 times forward earnings, a significant discount to its 10-year average of 20x, Barrick is often cited by analysts as the most undervalued of the senior producers. The 4 Mile discovery in Nevada, which could be the most significant gold find of the century, provides a massive organic growth engine with grades significantly higher than historical levels. Furthermore, Barrick's growing copper production provides a diversified revenue stream that is less volatile than pure gold plays. The primary risk for Barrick is jurisdictional volatility. The seizure of its Loulo-Gounkoto mine complex by the Malian government and subsequent ownership negotiations have created a geopolitical discount that weighs on the stock price. Additionally, the massive capital expenditure required for Reko Diq, $5.5 billion, and Lumwana, $2 billion, is increasing the debt load and might curtail funds for growth. Operational predictability in Nevada also remains a concern, as unplanned downtime at the Goldstrike roaster in late 2025 delayed production and forced a bottom-up operational review.
Kinross Gold has emerged as one of the best-performing gold equities of the 2025-2026 cycle, with its shares surging over 200% in a 12-month period. This re-rating is the result of a successful multi-year strategy focused on strengthening the balance sheet and advancing a high-margin project pipeline. In 2025, Kinross achieved a milestone by reaching a net cash position of $485 million, following the early redemption of $500 million in senior notes. The company reported record free cash flow of $700 million in the third quarter of 2025, driven by a 54% increase in margins that significantly outpaced the rise in gold prices. Management has leveraged this financial strength to enhance shareholder returns, increasing the 2025 share buyback target to $600 million and the dividend by 17% to $0.035 per share. With total liquidity of $3.4 billion and no debt maturities until 2033, Kinross is now in its strongest financial position in over a decade.
Kinross is refocusing its capital on North American development. The Great Bear project in Ontario is the cornerstone of this strategy, with advanced exploration infrastructure complete and detailed engineering for the main project advancing well. In the United States, Kinross is proceeding with construction on Phase X at Round Mountain, the Curlew project in Washington, and Redbird 2 at Bald Mountain. These projects are expected to contribute over 3 million ounces of life-of-mine production, significantly enhancing the grade profile of the portfolio. Key financial and operational highlights for Kinross in 2025 include production guidance, AUEQ, 2 million ounces, attributable free cash flow, $686.7 million for Q3, net cash position, $485 million, AISC guidance, $1,500 per ounce, plus or minus 5%, 2025 capital returns target, approximately $750 million.
The bull case for Kinross is centered on its status as a high-leverage growth play. With a combined IRR of 55% at $4,300 gold for its U.S. projects, Kinross is delivering some of the most capital-efficient growth in the sector. The company's flagship assets, Tasiast and Paracatu, continue to deliver record production and margins, providing the cash flow needed to self-fund the entire development pipeline. At a PE ratio of approximately 11x to 15x, Kinross remains a value alternative to Agnico Eagle, with a similar potential for jurisdictional de-risking as Great Bear comes online. The bear case is focused on the inherent risks of mining in West Africa and South America. While Tasiast is a high-margin asset, Mauritania has high royalty rates that escalate as gold prices rise, effectively capping some of the upside potential. In Brazil, Paracatu faces increasing metallurgical complexity, and though recovery rates improved to 81.6% in 2025, any future decline could impact production costs. Furthermore, Kinross's production is forecast to remain flat at 2 million ounces through the end of the decade, meaning the company must rely on grade improvements and gold price increases to drive further stock appreciation.
A comparison of the four companies reveals a sector that is increasingly bifurcated between the safety premium of Agnico Eagle and the value growth leverage of Newmont, Barrick, and Kinross. All-in sustaining cost is the most critical metric for assessing the long-term viability of a gold miner. Agnico Eagle's AISC leads the pack, offering the highest margin per ounce sold. However, Kinross and Barrick have demonstrated superior margin growth, meaning their profitability is expanding faster than the gold price itself due to disciplined cost management and higher realized grades. Newmont, while currently high cost, has the most significant potential for AISC reduction, as its $4.3 billion cost-saving initiative takes full effect through 2026. From a relative valuation standpoint, Kinross and Newmont appear the most attractive on a forward-looking basis. Newmont's PE multiple of 13x and Kinross 15x suggest they are undervalued relative to the S&P 500 and their own historical medians. Agnico Eagle's 24x PE reflects its bond proxy status in the gold sector, where investors are willing to pay for safety and consistency.
Reserves and resource replenishment. Sustainability in mining is defined by the ability to replace what is extracted. Newmont's 134.1 million ounces of reserves provide the longest production runway in the industry. Agnico Eagle's 54 million ounces and Barrick's 77 million ounces are high quality but require constant exploration success to maintain life-of-mine guidance. Kinross reserves of 21.9 million ounces appear low by comparison, but the company's conversion of 1 million ounces at Bald Mountain and the vast untapped potential at Great Bear suggests this number is conservative. Conclusion. The comparative analysis of the senior gold mining sector in 2026 reveals a group of companies that have fundamentally strengthened their operational and financial foundations. The focus on deleveraging, Tier 1 asset prioritization, and shareholder capital returns has transformed these entities from cyclical miners into robust, high-margin industrial cash generators.
For the conservative investor, Agnico Eagle remains the preferred choice due to its jurisdictional safety and fiscal discipline. For the value-oriented investor, Barrick Gold and Newmont provide significant upside through their undervalued asset bases and copper diversification. For the aggressive growth investor, Kinross Gold offers the highest leverage to the current gold price environment and a clear path to production de-risking through its Canadian and U.S. development pipelines. As global economic uncertainty and currency debasement continue to drive institutional demand for gold, these four companies represent the large-cap exposure to the sector, each offering a unique risk-reward profile tailored to specific investment objectives. The transition to value creation is positioning the gold mining industry for a period of sustained outperformance if the structural bull market momentum continues.